newsmakers, and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the AI arms race has boosted demand at ASML. The Dutch firm topped order expectations for its semiconductor equipment in the third quarter. Now, we break down the numbers with Bloomberg's Tom McKenzie in just a moment. But first, trade war fears front and center of the agenda once again after the U.S. president said the White House might target cooking oil with China, the latest escalation between the world's two largest economies. So let's bring in Jason Rogers, our senior editor for energy and commodities in China. Jason, so how much of an escalation is this?
Well, to be honest, you could argue that this may be a bit of a misfire from Donald Trump. I mean, if you look at the situation that he's addressing, he's clearly very angry that, China is no longer buying large quantities of US soybeans. Now, last year that trade was worth perhaps $12 or $13 billion. The cooking oil trade that he's targeting, by contrast, last year that was about $1 billion. So it's kind of asymmetric in terms of, his remedy for soybeans by actually targeting cooking oil.
So, Jason, what will be the response from China? Is it just going to escalate and escalate, or will anyone try to ratchet it down?
It's unclear precisely what raises hackles in Beijing. But the fact is that, targeting cooking oil, given the fact that actually over 2025 we've had a situation where cooking oil exports from China to the US have been in retreat in any case. Beijing is going to look at this and figure this really isn't any kind of, massive problem for the economy. It's probably a bit of a problem for certain commodity traders. They're going to have to, rejigger, their supply lines and that kind of thing. But I don't think this is something that is going to overly worry the powers that be in Beijing.
Jason, thank you so much. Now, ASML has also reported orders that beat analyst expectations in the third quarter as AI continues to fuel demand for its chip-making machines. Now, we're joined by our very own Tom McKenzie. Tom, thank you for joining us. So when you look at, the results, they were pretty good, but what really stands out?
Yeah, so the top line coming through for the third quarter, a pretty decent beat in terms of sales, 5.4 billion above estimates. Really interestingly, in terms of the extreme ultraviolet lithography machines, of which ASML is the only maker, that was also a really strong beat as well, 3.6 billion, well above the forecast of 2.2 billion. They also said that for 2026, sales should be about level with 2025. So there's a little bit more detail, even if they didn't give us the numbers for 2026. And clearly the AI momentum is serving ASML quite well. Christophe Fouquet, the CEO of the company, is saying that there is positive momentum around AI investments and it's extending to more customers. So if you think of the foundries like TSMC and Samsung, they need these machines to actually produce the chips that NVIDIA and others, AMD, are designing, and that is starting to benefit TSMC. Longer term, they stick to their targets, 2030, of trying to go for revenues of $60 billion US. That would be up from about 28 billion last year.
When it comes to China, a little bit of a different story because they're expecting actually 2026 not to be great in terms of demand from China. Yeah,
so China's really, really interesting to your point. So in fact, they saw net sales in the third quarter to China increasing at 42%, or making up 42% of all sales. So that was actually their biggest market in the third quarter. But to your point, Christophe Fouquet, the CEO, is saying that he expects that to decline pretty significantly into 2026. They have seen a pickup of customers there, particularly in the logic space as well, but at a time, of course, of increased scrutiny, particularly from the US. On rare earths as well, the CFO has just been talking in the last few minutes saying they have enough rare earth minerals and materials to tie them over because they are dependent on those for the next few months. So that's another factor that they're going to be scrutinised on as well. And they've seen more customers in China. They've got the rare earths to kind of tie them over. But at a time, of course, when trade frictions clearly between the US and China remain a prominent question for ASML, they're not able to ship their most sophisticated machines into the Chinese markets, but the lower grade ones they can still sell in to China for now, at least.
Tom, thank you so much. Tom McKenzie there with the very latest on ASML. So we have earnings. We, of course, have the Fed. And then we have this trade concerns between the U.S. and China. Stocks climbing as optimism over a Fed interest rate cut is lifting sentiment. Now, Fed Chair Jay Powell signaling that another rate cut is on the cards later this month.
The labor market has demonstrated pretty significant downside risks as payroll jobs have declined. And both the supply and demand for labor has declined declined quite sharply. So, those two states of affairs for our two goal variables, call for different monetary policy responses. So, as they come more into balance, I think the idea has been that policy should move from being, tight to some degree to being more neutral as those two things balance out.
Well, joining us now to put all of the dots together, Ursula Marchioni, EMEA Head of Investment and Portfolio Solutions at BlackRock. Ursula, as always, thank you so much for being here. I mean, there's always this U.S. trade tension that kind of flares up and then goes back down. You have, of course, a lot of questions on what central banks will do, and then we're in the middle of earnings season. What do you think drives investment in autumn?
Great question. Thanks for having me. So I think there's three main areas that I would look at. One is how to manage beta within portfolios. You referenced trade tensions. I think the volatility that we're seeing, the questions that we observe, continue to point to greater adoption of liquid alternative strategies, hedge fund strategies that can help continue to be exposed to growth, but in a manner that actually deliver some downside protection. A second element, Francine, that I believe will continue into year-end is the logic of regional and sectorial diversification. We've seen a lot happening this year at the back of the repatriation trade, European investors going back into European equities, Asian clients buying back Asian stocks. This has cooled down throughout the summer, but is set to continue to be a component and a lever for clients to diversify portfolios. And then the third element, I think, in terms of, we just saw Chair Powell, government shutdown and the absence of data, we see now CPI being postponed to the 24th, points to the fact that big data can be a great friend in an environment where official statistics are on pause to understand what's happening. And so systematic strategies that look at, for example, satellite imagery or reading of consumptions in terms of credit cards can give some insights in terms of the real state of the economy and help investors continue to generate alpha in portfolios.
Ursula, I mean, it feels like the tide shifted in terms of the market's focus, for example, on tariffs full stop or on inflation full stop. And I don't know whether, someone spoke to the IMF head who was saying, trade is a little bit like water. If there's an obstacle, it still finds its way to where it needs to be. Or whether there's a belief in the markets that the Trump administration is pretty much at the end of what it's been trying to do on tariffs.
I like the water analogy. I think a big lesson for me this year has been that disentangling big economies is a very difficult thing to do in terms of if we think about rare earths need in the US, if we think about chip needs in China, those aren't things that you can solve overnight. And so again, while obviously going towards end of the month and South Korea, there'll be messaging and noise that will continue. I believe that a central scenario where in the end some form of compromise is found is in everybody's interest. And so again, it points towards opportunities towards year end, but I go back to my point around selectivity. Yeah. For instance, my team looked at equity return variance recently. 70% year to date is explained by factor and sectors. We haven't seen something of that level for some time. And so again, going into year end, thinking about not only regions but also sectors within those regions will be very important.
So I imagine some sectors are priced to perfection, and it also, I don't know whether it's a quirk of the market because there's so much money chasing the same story. We also saw this broken correlation between stocks and bonds, which you write so eloquently about. I don't know whether we ever go back to the world that was.
It's a great question. I think it's difficult to see that great moderation, perfect setup that supported the 60-40 performance for so long. But again, this idea of diversifying diversifiers has a lot of room to go. Private markets, speaking about gold, which again is at record high, but has a role in portfolio that hasn't been fully played out by investors, I think are elements that we need to think about. And then sectorially, thinking about Europe, banks, defence, industrial, great areas for different reasons, but all worth being looked at. And in the US, healthcare, financials, and AI, which beyond the news and the questions, continues to deliver from an earnings perspective.
I mean, this is the big question, right? Because AI A lot of portfolio managers have a difficult relationship with it because you can't stay away from it, but at the same time, valuations do look very, if not expensive, priced to perfection, and yet we get surprised. How do you deal with AI?
Yes, so we continue to like the AI megaforce and see a positive way forward. If you think about questions in terms of parallels to 99, the leverage in the system isn't at that level. A lot of the capex is financed from free cash flow. The earnings continue to deliver. Alex Brazier, our global head, recently mentioned that what we observe in market is a mirror of what is happening in the economy. It's not a bubble, it's a mirror. And that concentration that we see in the growth of the US is real and is structural. And so again, with cautious and with continued attention, we believe there's opportunities to capture it in portfolios.
Ursula, what's your take on defense? So again, defense seems one of the major structural shifts actually for Europe. There's a question on whether there will at some point be some M&A in the sector, or whether even if without M&A, it'll just grow and grow in Europe.
Yeah, I think it's an interesting question in the sense that there's clearly a structural shift that has been set in motion and will continue to play out. At the same time, defence and industrial do also allow investors to be more domestically focused, which at a time where US dollar weakness is set to continue is also a very attractive feature.
I mean, do you always look at it relative value with the US? And so, we talk a lot about also European competitiveness and whether that actually goes into European earnings compared to US ones, and maybe in the next couple of quarters.
Yeah, that's a great question. And if we look at just the Q2 seasons, we looked at the US, low double-digit EPS growth versus Europe at 0.5%. So there is a clear gulf between the two. And yet, going back to what we are observing this week so spectacularly, the element of diversification continues to be important. And so again, yes, it is about the absolute prospects, but it's also about how do you build a portfolio that can weather shocks and volatility that this week in particular we see, and the end of last week as well, we see continuing to play out.
Ursula, thank you so much for joining us. Ursula Marchioni there, EMEA Head of Investment and Portfolio Solutions at BlackRock. Now, coming up, a political lifeline for France's Prime Minister Sebastien Lecornu. But will it hold? Well, we'll discuss all of this with Charlotte de Montpellier, Senior Economist at ING. That's next, and this is Bloomberg.
The popular support in public opinion polls for the euro is at the highest level ever reached. 79% for French citizens, 83% for Europeans. So it's not a debate about Europe and the euro. It's a debate about how to reduce the fiscal deficit.
Well, this is the Banque de France Governor, François Villeroy de Galhau, telling Bloomberg that the country must make major spending cuts to help bring down a budget shortfall that's fueling the political turmoil. Now, political tensions ease in France after the Prime Minister, Sebastien Lecornu, won the crucial backing of the Socialist Party in the National Assembly. It comes after he promised to suspend President Macron's unpopular pension reform.
C'est pourquoi je proposerai au Parlement dès cette...
This fall, I will propose to Parliament to suspend the 2023 pension reform until the presidential election. No increase in the retirement age will take place from now until January 2028, as specifically requested by the CFDT union. In addition, the duration of work taken into account will also be suspended and remain at 170 quarters until January 2028.
Let's bring in our very own Caroline Conan in Paris. Caroline, lifeline for Sebastien Lecornu and his government.
Yes, you could see on these pictures the former socialist president François Hollande clapping at the announcement that Lecornu is suspending the 2023 pension reform. You could see the first secretary of the Socialist Party, Olivier Faure, smiling. It's a big victory for the socialists. They are offering a lifeline to Sebastien Lecornu by saying they will not try and topple him during these two motions of no confidence that will be examined in Parliament tomorrow morning, proposed by the far left and the far right. Clearly, they have become the kingmakers in Parliament, and Lecornu knew he had no other choice. Everyone in his entourage had been saying, you need to suspend the pension reform or we are likely to see another government collapse. And there was a sense, even within Macron's camp, that another government collapse could have cost even more to the French economy and to the French deficit. In the short term, suspending this reform will cost, according to Lecornu, 400 million euros next year, 1.8 billion euros the following year. But of course, this means Lecornu, in the short term, should survive this week.
So what about the debate on the budget?
The debate starts now. Lecornu has actually given the power back to Parliament by saying he will not use the 49.3 article in the Constitution in order to force the budget bill through Parliament. So every single measure will be debated. Lecornu proposed an initial draft yesterday that included 30 billion euros of savings, 2/3 coming from spending cuts, 1/3 coming from new taxes, the super tax on big companies extended. But of course, the socialists will want more. They have already said they will put back on the table the so-called Zuckman tax on those with more than 100 million euros of assets. So the debate will be heated in Parliament for the next 70 days so they can pass a budget by the end of the year. And what happens once a budget is passed is anyone's guess.
Caroline, thank you so much. Caroline Conan there in Paris. Now joining us is Charlotte de Montpellier, senior economist at ING. Charlotte, I mean, there's so much concern actually in the markets that France is the new Italy, that it's the bad student of Europe. But what's the next frontier for France? Can Sebastien Lecornu hold on to power and get something done?
Yeah, so let's hope the budget can go through. Actually, the suggested budget that he made yesterday is quite ambitious, I would say. So with a target for the deficit to reach 4.7% next year. But I think the likelihood that it goes as expected will be very low. So it means that the debate in Parliament will probably bring a completely other budget. The thing is that the situation, the public finance situation of France is deteriorated and actually has become even more deteriorated because of the suspension of the pension reform. So this means that the savings they need to find are very, very, very big, and the likelihood that the Parliament will reach that point, will be able to find an agreement on the savings is very, very low. So I think it's not the end of the story. We are in a situation with less political instability. That's good, but the public discussions are going to get worse probably about the budget.
Charlotte, is there anywhere where they can actually find some money without doing too much harm? Is there any low-hanging fruit?
No, I mean, that's the problem. So it's not so easy to find ways of having savings that is okay with public opinion. And we have seen with the pension reform that all the reforms that actually are aiming at having less spending are very, very difficult to go through with the public mind. So that's a bit the difficult situation. And the issue is that it's not only for this year, for 2026 budget, but it will be the case for each and every year. So the suspension of the pension reform as such will bring a need to find 3 billion euro more next year in the budget. So it's a lot, and it will keep increasing every single year. So low-hanging fruit will not be enough, and they will need at some point to tackle some major reform, but it's not happening in the political situation as it is right now.
Charlotte, what does it mean for the markets and, of course, a lot of bond vigilantes trying to test France? Do you think that we could see, for example, spreads between Germany and France really getting to concerning levels?
I mean, right now the situation has been seen as a bit of an improvement because there is less political instability, but I think we should not be too optimistic. And the budget discussion in the parliament will very briefly show that it's not solved. The underlying issue is not solved. So it means that political instability is likely to return. And it means that the spreads, they can even go up a bit. So I wouldn't be surprised if at some point in the current next weeks or months, we see spreads going up again, reaching 90 basis points, could even at some point reach 100 basis points. Because the political situation is so difficult that actually the possibility or the likelihood that we are going to find a way in order to have a budget situation that is improved not only for this year but for next year and the years after, and that we are going to at some point see the deficit going back to 3% of GDP is very low at this stage, so probably means there is still the likelihood of some upward pressure there for the spreads.
Charlotte, how problematic is 100 basis points difference? And actually, is that a point where the ECB has to step in, or is there anything that the French government would be able to do?
No, it's not. I mean, I don't think the ECB will want to intervene at that moment. Let's be honest, this is due to a political situation, a political problem, and it's not due to some stress on the market, on some difficulties that are unwarranted. So it's not the case. It's actually a political situation. So I think the bar is very, very high for the ECB to intervene. But of course, the fact that they have this possibility, they would be able to intervene if really the situation would be very bad or would worsen very much. That as such is helping markets to relax, to be a bit of more peaceful. So the existence of this TPI instrument by the ECB is enough to probably calm a bit the market and not have so big of a widening of spreads. I don't think they will actually use it, but it exists, so it means that the situation can probably not deteriorate too much. That being said, I think the public finance situation and the public finance problem will remain a key topic for Europe in the next years.
Charlotte, you work for ING, I work for Bloomberg. We love numbers. So what do you think the probability of actually Sebastien Lecornu passing something of passing a budget compromise is? Is it 50% or is it higher, 60, 75%?
Yeah, very difficult to say at this stage because it's very early moment and we don't have the reaction of all political parties yet. I think there will be a discussion in the parliament. So there is a likelihood that they find an agreement, probably maybe around 50 or a bit above 50%. But if it's the case, it means that the budget that will go through, that will be voted, will be completely different compared to the one that has been announced yesterday. And so if there is an agreement at the parliament, it will be for a completely different budget. And in that case, I would expect that the deficit reduction will be much smaller than what has been announced yesterday. So I think it will remain very, very clear that there is an underlying underlying problem for public finance. And that's very difficult to solve, actually.
Charlotte, thank you so much. Charlotte de Montpellier, their senior economist at ING. And of course, then we need to see whether there's even a possibility that Emmanuel Macron also resigns before his term is up. But let's have a look at luxury stocks because LVMH shares are surging. The company returning to sales growth in the third quarter. This is something that's very encouraging for the rest of the sector, and especially, as LVMH said, it saw encouraging demand in China, with sales in the region rising some 2% last quarter. It also posted growth in its wine and spirits division. Coming up, what AI means for impact investing across emerging markets. We discuss with Andy Kuper, founder and chief executive of Leapfrog Investments. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. The Fed Chair Jerome Powell signals another rate cut is coming later this month as investors weigh renewed trade tensions between the U.S. and China. The French Prime Minister Sebastien Lecornu boosts his chances of surviving this week's no-confidence votes after dropping plans to raise the pension gap. And luxury stocks soar after LVMH reports a surprise return to growth, suggesting a persistent slump in demand is actually easing. Now, the AI story is largely dominated by corporate earnings like ASML today and the tech arms race between the U.S. and China. My next guest says this often ignores how the technology is pushing inclusive growth for consumers in emerging countries like Asia and Africa. Well, joining us now is Andy Kuper, Chief Executive of Leapfrog Investments, a venture capital private equity firm with a focus on EM and impact investing. Andy, thank you so much for joining us. Now, first of all, this was an extremely interesting angle because you're right that AI, especially in emerging markets, can mean inclusive growth as long as you're not left behind.
Absolutely. Well, great to be here. And I think the dialogue globally around AI is missing a huge piece. It's focused on the arms race between the likes of OpenAI and Anthropic. But actually, the really interesting thing here is the way billions of customers are joining the economy and are engaging in a much more intensive way. You don't even need to be able to read or write these days in order to engage, in order to get a bank account in India, in order to acquire different financial services, healthcare, education. These things all are now possible for you because of a natural language form of engagement. And you're seeing companies that are growing based on this AI capability that were completely unthinkable 5 or 10 years ago. We have a company called Healthify that provides coaching on nutrition and food and weight loss to over 40 million people in India. And that company basically allows the AI to talk to people in their own language, knowing what their own local cuisine is. No individual could say, I know in 100 languages what the local cuisine needs are, and serves those people. And if you think about India as the diabetes capital of the world, the loss of weight for these folks and the improvement in their cholesterol is dramatic. So you're seeing social impact and you're seeing business opportunities at a scale that was inconceivable thanks to AI.
But and I mean, there must be an entry to barrier, right? I mean, I had a conversation with Queen Maxima of the Netherlands at UNGA, and she does a lot on financial health. And actually, the numbers of people that don't have a bank account now is absolutely staggering. And I don't know whether it is because it's a lack of access or reading and writing, or it's just that it's not in their world.
So our world is changing dramatically in this respect. You're right. And Queen Maxima and I just had dinner, actually. And there are 1.4 billion people who lack bank accounts and 740 million people who are illiterate. The amazing thing about AI engagement now is that while we in the developed world are often using text and text prompting to continue to engage, people in the developing world are primarily using voice and engagement. And so that changes things dramatically. Also, if you look at those people in the developing world, here in the UK, we would say, well, is AI going to improve the lives of people like us? So when they do surveys, 42% of people say that. In South Africa, in India, it's 76%. And in Nigeria, it's 95%. And why is that? Because people are beginning to engage with this technology in a way that is completely different and is allowing for these customers that didn't sit on the grid before or only consumed a limited amount to consume vastly more. If you are an investor like us, a capital allocator driving returns for your limited partners, and you look at this, you say, wow, sure, OpenAI is the picks and shovels, but there is a gold rush going on here, and we can be backing the best miners across our portfolio to really generate high value for our investors here, and we can be changing the world for those individuals who have lacked these essential services for so long.
I know you touched at the beginning, but what specific sectors? So if you look at healthcare, is it the enterprise, is it the app, or is it the software that goes into that AI?
So I think all of this is on the table. What we focus on at Leapfrog is the emerging consumers and their actual experience, so B2C companies. Today, our companies reach 560 million people across 35 different emerging markets, the likes of India, Vietnam, Indonesia, Nigeria, Kenya. If you really take that into account, that is more people than all of the European Union and the UK, or more people than all of North America. And those customers were off the grid or very difficult to reach just 10 or 15 years ago. So now what we're going to see is that accelerate. Instead of 4 billion customers, now you have 8 billion. But once there are AI engagement and those people have AI enablers and agents, you're going to see 16 billion or 20 billion actual potential customers. And that completely changes the total addressable market, completely changes the kinds of companies we invest in.
And I guess it's a little bit too soon right now to know who the real winners and losers are, because it's so rapidly changing in terms of technology.
Well, that's why you need people on the ground, investors on the ground who have built a capability in these sorts of areas. So we invest in financial services, healthcare and climate solutions. And you can actually see a number of the features of these winners. You can see if they're technology and AI enabled. You can see if they're operating in spaces that can be easily disintermediated by AI. For example, insurance. We all know how painful it is to make a claim in insurance, and it can take weeks or months in Sydney, London or New York. Well, we have a company called SoftLogic in Sri Lanka, where 97% of claims are paid in the first 24 hours.
I've never heard of that. That's almost unbelievable.
Right, and it's the top life insurer in the country. This is not small, and the number 2 health insurer. Further, you're basically enabling people to submit very simple documents or very simple bits of evidence, but because of the AI, it's able to detect fraud, it's able to check treatments, able to do all of this very quickly. Now, if you're seeing that in developing markets, it's going to come here. It's only a question of time.
And it's a little bit like Deliveroo, right? I mean, they give you a refund quite quickly, but it's on algorithms. So there's always a concern about biases. I mean, again, as we use more and more of these products, do they get better?
Correct. It does get better, and the wonderful thing about very large numbers of people reached is that you have a large N, you have a large capacity to revise and improve these things. But there is no doubt that we need principles for responsible AI. We need to be able to audit for bias. We need to be able to track the reasoning logic of the AI. I will say, though, that in the developing markets, in particular, the optimistic story is far stronger than the pessimistic story. So while there may be some biases creeping in and there may be work that you need to do to improve the algorithm, the fundamental thing here is that these customers are being empowered, they're acquiring more services, and you're creating industry champions at a pace and a speed that is unprecedented in human history. I mean, this is why we at Leapfrog think that the AI revolution goes beyond this analogy of the printing press. It really is like the development of farming or the French Revolution, which is an agentic revolution, where suddenly the forms of agency, who has agency, and their sense of having destiny, power over their own lives, really comes through. And this makes AI, I think, much more exciting even than the folks spruiking it for data centers in the US like to talk about, because it is a whole different change in who acts, how they act, and therefore how companies can act and how allocators can allocate capital.
I know we've had a couple of conversations with Google. I mean, if the barrier to regulation is lower, how do they make sure it's safe everywhere? Andy, thank you so much for joining us. Andy Kuper there, the Chief Executive of Leapfrog Investments. Now, LVMH surging this morning after the luxury firm's sales unexpectedly returned to growth in the third quarter. Bloomberg's Angelina Rasquet joins us now from Paris. Angelina, good morning. So what's fueled growth at LVMH this quarter?
Hi there, Francine. Indeed, I mean, overall it was a very positive result. All the units beat estimates, and crucially, the key fashion and leather goods unit did too, even though it still posted a negative, a drop in sales in the quarter. But the improvement, as the CFO explained, was driven by better traffic and volume. So it wasn't a price effect. The wines and spirits unit, which had been struggling for the past 2.5 years, also returned to growth, and that was helped by champagne restocking in the US, as well as resilient demand for rosé wines, even though cognac is still suffering. And Sephora in the US was also, also showed a very strong performance when it comes to selective retail. And geographically, the only region that worsened was Europe. That is because tourists in Europe are spending less with the weaker dollar. But the region that includes China returned to growth, and that is really what the market was hoping for and what the market got.
So what does this suggest for the luxury sector?
As we saw this morning, LVMH, the stock rose 13%. It lifted all the rest of the sector. We'll have LVMH is one of the first ones to report. We'll have more companies reporting next week, notably Kering. The issue with Kering is that it's in turnaround mode. They just appointed a new CEO. He took over last month. They have a new Gucci CEO as well, a new Gucci designer. We'll have results also from Hermès next week. This one tends to be more resilient. So we'll see. And Richemont, which is very exposed to jewelry because of Cartier and Van Cleef, will report in November. But overall, yes, there are hopes that China. The question is, has China turned the corner? I think it's probably too soon to say for sure. And the CFO of LVMH actually explained that the current quarter has tougher comparables because last year in particular, the US was very strong following the US elections. So this will not be easily replicated. So that's pretty much what we got.
Angelina, thank you so much. Angelina Rasquet there in Paris. Now coming up, JP Morgan reports bumper earnings, but Chief Executive Jamie Dimon warns of cockroaches in the credit market. Details next. And this is Bloomberg. Now, Stellantis says it will invest $13 billion in the U.S. over the next 4 years as the automaker seeks to curb the impact of tariffs and reinvigorate its business. It marks the company's single biggest investment in America in over a century. We're joined by Stéphane Nicolas, our team leader for EMEA Auto. Stéphane, a massive sum. Good morning. A massive sum. Run us through the details.
Yeah, it's indeed a big sum. Investments in several plants across the United States, in new models, in research and development, but also Stellantis noted supplier expenses. So that's a sort of a tiny caveat that the 13 billion will also include supplier expenses. But of course, it will create jobs. And, it's part of Stellantis's plan to really improve its business in the U.S.
So, Stéphane, is President Trump's plan to bring automaking back to the U.S. actually working?
Well, that's a good question. We'll probably see that in a year or two. But certainly Stellantis has promised that this move will create jobs. And, other companies have announced similar investment plans. Whether this will create lasting jobs, we'll have to see. Of course, tariffs are never great for the automotive industry because they add costs and that crimps margins. And that, in the long run, isn't great for these companies and the jobs they secure. But certainly the Stellantis announcement is a news that should please the union in the U.S.
Stéphane, thank you so much. Stéphane Nicolas there, our team leader for EMEA Autos. Now, Wall Street's biggest banks have reported record growth. JP Morgan's chief executive set, though, a cautious tone, warning of risks in the credit market. Now, Jamie Dimon's comments follow the collapse of auto lender Tricolor, which resulted in a $170 million hit for the bank.
You should assume that whenever something happens, we need to scour all process, all procedures, all underwriting, all everything. And, we think we're okay and other stuff, but my antenna goes up when things like that happen. And I probably shouldn't say this, but when you see one cockroach, there are probably more. And so everyone should be forewarned on this one.
I mean, we say he's cautious, but he's also straight to the point. Our Charlie Wells is here to discuss. Charlie, when you look at actually what Dimon is worried about, I mean, he's usually on the money. So what does it tell us about the rest of the banks and what they should be looking out for?
Francine, really on the money there and using cockroaches to address the elephant in the room, I would say, this concern about credit markets, about what other problems might be out there following that spate of bankruptcies we saw in the auto space. So really reflecting some concerns, some questions that analysts had and not running from that, saying there could be more out there. This reflected a number of the other comments we heard from executives at these top Wall Street banks. We had Mark Mason at Citi talking about a consumer spending a little bit less, being a little bit more cautious with how consumers are using their discretionary income. We had David Solomon talking about potential winners and losers in the AI space, given a lot of the optimism that we've seen. But this overshadowed some really stellar numbers. You look at investment banking fee growth, you can see that at Goldman, growth of 42% in that third quarter. That was a record for Goldman Sachs. You saw stellar reports across the board in investment banking fees, in trading fees as well. But when you take a look at how the market responded, you do not see this reflected in the share prices yesterday. You can take a look, a slip for Goldman Sachs, a slip for JP Morgan. You saw some positive responses to other banks. But again, this was overshadowed by some of that commentary and perhaps some over-enthusiasm for banking stocks in recent weeks.
Yeah, no rest for the wicked. There's more earnings today. What can we expect from the banks?
So coming up, we've got two giants on tap. We have Bank of America, and really important there is to focus on net interest income, given the lending business they have, given the exposure to the consumer, really focusing on that, especially given the state of rates, the change that we have had, given that rate cut in September. And then we have Morgan Stanley, arch rival to Goldman Sachs, coming up. You can look at the share prices of these banks. You can see how competitive this is. You can see how much optimism there's been for the likes of, say, Morgan Stanley coming out there. Investment banking fees will be in focus as well as trading. Bank of America lagging a little bit. There could be potentially an upside surprise here, but we'll find out in a few hours when these earnings drop.
We certainly will. Charlie, thanks so much. Charlie Wells there with the very latest on the banks. Let's now bring in Paul Davies, our bank and finance columnist from Bloomberg Opinion. Paul, thank you for joining us. I loved your column. So we woke up and we said, let's get Paul today on TV, because basically you say big banks are on fire. Why is the Fed eyeing more fuel? And there's this idea that, look, banks are having a great quarter. They're increasing financing to it's just going through the roof. And so it could be really tricky to contain risk if the Fed cuts interest rates.
Yeah, no, exactly. I mean, we've got this kind of, this bifurcated, I guess, news coming out in the sense that everybody's doing spectacularly well. JP Morgan had its best third quarter for trading ever. I mean, all of the banks reported, investment banking fees that were the best since 2021, which was when we had that, huge boom post-COVID and post all of the extra money that went into markets. But at the same time, we've got Tricolor and First Band, and it's, are they cockroaches? Are they canaries in a coal mine? It's like my head's spinning from all of these animal metaphors. I mean, the point is that both of those potentially have some fraud involved, so they may be idiosyncratic, but at the same time, you might keep seeing more of these, one-off, odd, overextended situations coming, and that's... Yeah.
Does it go back to exuberance? I mean, is that the word, like with deregulation? Do you worry about something, and you're right, there are a lot of animal metaphors, that something just going badly because we're too optimistic?
Yeah, no, absolutely. I mean, we've had stock markets, apart from, the interruption in April after Liberation Day, stock markets riding high all year. Credit spreads are incredibly tight. We've already had executives this year talking about how exuberant markets are. And this really doesn't seem like the kind of market that you ought to be throwing interest rate cuts at, especially when you're just slightly worried about a bit of economic slowdown next year and a bit of softening in the labour market. And also, there's a wave of deregulation that people keep thinking the White House is going to bring. Alvarez and Marshall, this consultancy, put out a report, a somewhat punchy, somewhat optimistic report, in my view, this week, saying that up to $140 billion of capital could be freed up from these big banks. And it's like, okay, even if some of the biggest, most sensible banks don't throw that into the market themselves straight away, that's going into the pockets of shareholders who need to find something else to do with it. So it just all feeds this, incredibly heated sort of market scenario already.
But Paul, if you look at the things that go wrong, which I know you do very well in your columns, or you try and shift through, I mean, how much of that is just this market bubble because of AI? That keeps on being supported, by the way, but that's a big question mark that lingers over everything.
Yeah, I mean, that's the big question. I mean, in a lot of ways, people were sort of relatively comfortable with it for a while because we thought, okay, a lot of this investment in data centers particularly is coming from the cash flows within a lot of these, VC and AI companies. But JP Morgan's their analyst did a study last week, I think, about the amount of debt now going into some of this stuff, and AI connected, investment grade debt issuance overtook banks as the biggest single sector of debt issuance now. So it's not just the cash that VCs can afford to burn, or that Microsoft or whoever are throwing into OpenAI, there's also a lot of debt going in there, and it's coming from private markets and it's coming from public markets too. So
yeah, private markets. I mean, if you're deregulating the banks, what happens to private markets? Is there talk, in the U.S. of having a closer look to private markets? Not so much.
No, not so much. I mean, in fact, what the White House has been doing more is rowing back from some of the Joe Biden era regulation that was trying to get, more insight into private funds and this sort of thing. One of the big concerns that's been building for a long time is just how much the banks are lending into the non-bank area, including to kind of private markets, private credit fund managers and this sort of thing. And indeed, JB Diamond of JP Morgan got some questions about this from analysts yesterday on the call. I mean, and again, there's like, at the higher quality end, everybody is very comfortable. They think they've got a lot of good collateral and everything is well secured, but there's the lending standards within some of those people that banks are lending to, and especially at the lower end and the riskier end. And it's like, yeah, when do some of these things start to go a bit funny,
Okay, so what are you writing on today?
Well, I'll be looking at Bank of America and Morgan Stanley just to see, how they line up next to the fall that we saw yesterday, and to try and get a better sense from them about what they think is coming in terms of deregulation, fourth quarter activity, and activity into next year.
Paul, thank you so much. We're such a fan of your columns. Paul Davies there from Bloomberg Opinion. Now, let's return to Jay Powell and those comments, of course, about a potential Fed cut. Joining us now, Nora Melinda, our markets correspondent. Nora, so great to have you, and in the London studio. So how are the markets actually digesting those comments from Jay Powell?
Well, today we are seeing stocks in the green, at least as we're looking at futures here ahead of market open. I mean, we did see them end lower yesterday at market close on Wall Street. I mean, people are really just looking to Jay Powell for any sense of relief right now. I mean, there's so much uncertainty in the market. So it's really just about people seeing this a little bit as him waving a green flag, if you will, in amidst a cloudy backdrop here. I mean, of course, he's talking about a slowdown in the pace of hiring and potentially potentially weakening further here. So it really is people just trying to figure out how to position themselves in a very, very cloudy backdrop.
Yeah, not easy when you don't get data because there's a government shutdown. Right. So how are the markets positioned?
I mean, given the fact that there's an absence of data, we're really looking for any sort of indication about the health of the economy. People are really pointing toward rate cuts here at the end of October, coming off of the rate cut that we just received back in September. So, I mean, we're going to get the beige book later today, and also people are really digesting the bank earnings as kind of a proxy here in the absence of data. But you're seeing a bit of a flight to safety. I mean, you're seeing some bids here on gold.
Yeah, I mean, gold is unstoppable, right? It really definitely feels like that. When you look at the U.S.-China, how's that playing out? Because everything seems to have upped the ante.
Yes, I mean, headlines flying left and right here. People really on the edge of their seat as to what's happening next. But, I mean, that definitely continues to be a very uncertain dynamic, as there's a bit of a tug of war from both sides. So it feels like a tug of war between the bears and the bulls right now. But, I mean, if you look at the markets right now, year to date, we are still seeing double-digit gains on the S&P 500 on the year. So, I mean, it's really just about what happens next year. And the tariff, of course, conversations will continue, and something that we're really going to be parsing as we get through these earnings during this corporate season.
Yeah, so Nora, how much actually are they looking at earnings, and how much are they just doing what the Fed does to help them out?
It sounds like a little bit of both. I mean, as I'm chatting to sources, of course, people are going to look to earnings to kind of get an idea of how the economy is being underpinned. People, of course, digesting what we saw from banks just yesterday, and as it continues moving forward. But it really is going to be a modge podge of whatever you can grab. You got to listen and see what it could potentially mean moving forward here.
Yeah, I mean, questions for investors. It's like, how do you cut the noise from the real stuff?
Absolutely.
Right? And that's the hard bit. Nora, thank you so much. Nora Melinda, our markets correspondent. Up next, Bloomberg Brief. There's a lot going on in the markets. The stock rally continues. We were talking with Nora about gold, for example, topping 4,200. Global stocks advancing again. Strong earnings seem to have reignited some of the risk appetite. The markets that frankly have been whipsawed for days by these shifting trade war fears. Gold surging above 4,200 an ounce, and that again boosted by U.S.-China frictions and also expectations for Fed easing. Dollar falling against all major peers. Bets that the Federal Reserve interest rate cuts have been growing, but also China, I think, stepping in to support the yuan. We'll have plenty more throughout the day, and this is Bloomberg.